Howard Marks, Second Level Thinking, Nobel Mind Series. The architecture of second level thinking. There is a profound difference between intelligence and advantage. Intelligence processes information, advantage processes expectations. This distinction defines the architecture of second level thinking. Markets are not classrooms. They do not reward correct answers in isolation. They reward answers that differ meaningfully from the consensus, provided those differences are correct enough. This is the first structural insight. If everyone agrees that a company will grow rapidly, that belief is already embedded in the price. Buying that company does not create edge. It creates exposure to expectation risk. Second level thinking begins where linear reasoning ends. First level thinking asks, is this good? Second level thinking asks, is this better or worse than what is already assumed? This requires intellectual inversion. Most analytical frameworks train individuals to evaluate intrinsic quality. They assess earnings growth, competitive positioning, macro trends, leadership competence, innovation pipelines. All useful, none sufficient. Because the market is not asking whether something is good. It is asking whether it is better than expected, The difference between good and better than expected is the difference between average return and excess return. Second level thinking therefore requires dual analysis. 1, fundamental analysis. 2, expectation analysis. Fundamental analysis asks, what is likely to happen? Expectation analysis asks, what does the market believe will happen? Edge exists only in the delta between those two. This is why second-level thinking feels uncomfortable. It demands that you understand not only your own reasoning, but the reasoning of others, and the collective emotional temperature embedded in price. Price is not a number. It is a psychological artifact. Every price reflects forecasted cash flows, assumed growth rates, risk premiums, liquidity conditions, narrative intensity, recent memory, social reinforcement. Second-level thinkers reverse engineer price to uncover embedded beliefs. If valuation multiples are extreme, expectations are extreme. If spreads are compressed, risk tolerance is elevated. If assets are abandoned, pessimism is dominant. The architecture of second-level thinking rests on one principle. You are not competing against reality. You're competing against consensus perception of reality. This changes everything. It means your analysis must be comparative, not absolute. It means a recession does not necessarily mean stocks fall if the recession was already priced in. It means strong earnings do not guarantee gains if those earnings were anticipated. It means that the quality of a business and the quality of its stock are separate questions. This separation is rare. It is intellectually easier to focus on fundamentals. It is emotionally harder to assess psychology. Second-level thinking demands both. It is layered thinking. Layer 1, the asset. Layer 2, the consensus. Layer 3, the embedded emotion. Layer 4, the asymmetry if consensus is wrong. Most participants operate at layer 1. Second-level thinkers operate at layer 4. This does not require arrogance. It requires humility. Humility to admit your forecast may be wrong. Humility to assume consensus may also be wrong. Humility to require margin before action. Second-level thinking is not about superior IQ. It is about superior positioning. And positioning begins with understanding that markets are forward-looking, discounting machines. The present price is not a reflection of the present. It is a reflection of the anticipated future. Therefore, being right about the present is irrelevant. You must be right about how the future will differ from what others believe. This is a probabilistic game. It is not about certainty. It is about miscalibration. Small miscalculations in growth assumptions, risk premiums, or durability create disproportionate price movements. Second-level thinkers focus on miscalibration. They ask, is optimism excessive? Is fear excessive? Is leverage expanding? Is liquidity masking fragility? Are narratives suppressing skepticism? They look for extremes. Because in equilibrium there is no edge. This is why patience is structural, not emotional. Second-level thinking accepts that most of the time the market is roughly efficient. The goal is not constant action. The goal is selective action. Selective action requires waiting for moments when expectations diverge from reality sufficiently to create margin. That divergence often appears during emotional extremes. And this brings us to the next section. why first-level thinking dominates markets, and why intelligence alone cannot escape it. Why first-level thinking dominates markets. First-level thinking dominates markets not because people are unintelligent, but because markets reward speed, coherence, and social alignment in the short term. First-level thinking is linear. It connects facts directly to conclusions. Growth is accelerating implies buy. Inflation is rising implies sell bonds. AI is transformative implies own AI stocks. Recession risk is high implies reduce equities. These statements are logical. They are often correct. They are also incomplete. The structural problem is that first-level thinking treats information as if it exists in isolation. It assumes that identifying a fact produces advantage. But markets are ecosystems of interpretation. Every visible fact is processed by millions of participants simultaneously. When information is widely available, advantage cannot come from merely observing it. First-level thinking persists because it feels rational and productive. It rewards effort. It allows analysts to demonstrate knowledge. It produces confident forecasts. It is communicable and persuasive. Second-level thinking, by contrast, is quieter. It begins by questioning whether the visible conclusion is already priced. The reason first-level thinking dominates is psychological. Humans are wired to interpret events in direct cause and effect terms. If earnings rise, price should rise. If conditions deteriorate, price should fall. This linear mapping feels intuitive because it matches everyday life. But markets are not everyday life. They are anticipatory systems. Prices move not on what is happening, but on the difference between what is happening and what was expected to happen. This difference is subtle but decisive. If everyone expects earnings to grow by 20% and they grow by 20%, nothing happens. If they grow by 18%, disappointment emerges despite strong performance. If they grow by 22%, euphoria emerges despite only a marginal improvement. First-level thinking evaluates the number. Second-level thinking evaluates the surprise. Markets reward surprise relative to expectation. This is the first structural reason first-level thinking fails. It ignores embedded expectations. The second reason is social reinforcement. Markets are social environments. Consensus feels safe. Agreement produces validation. Analysts, fund managers, commentators, and institutions are influenced by reputational dynamics. Being wrong alone is painful. Being wrong together is tolerable. First-level thinking aligns with consensus more easily because it builds on visible information. If a narrative is dominant, it is psychologically costly to oppose it. Career risk increases. Social friction increases. Underperformance during speculative phases invites criticism. Second-level thinking demands psychological independence. That independence is rare not because it is difficult intellectually, but because it is costly socially. The third reason first-level thinking dominates is time compression. Most participants operate under performance measurement cycles, quarterly results, annual comparisons, monthly reports. These cycles encourage responsiveness to visible developments. Second-level thinking often requires waiting for mispricing to correct. That may take months or years. During that waiting period, performance may lag. Short-time horizons favor first-level reactions. Long-time horizons reward second-level positioning. The fourth reason is narrative clarity. Humans prefer stories to distributions. A story that says electric vehicles will dominate transportation is compelling. It is vivid. It provides direction. It creates identity. A second-level statement, electric vehicles may dominate, but expectations may already exceed realistic growth trajectories, is less emotionally satisfying. It is probabilistic, not declarative. Markets amplify clear narratives because narratives coordinate behavior. When many people believe the same story, price momentum reinforces belief. First-level thinking thrives in narrative environments. Second-level thinking requires stepping outside the story and examining its fragility. The fifth reason first-level thinking dominates is confirmation bias. Once an investor adopts a thesis, information is filtered through it. Supporting evidence is emphasized. Contradictory data is minimized. This creates conviction. Conviction feels like strength. But conviction without calibration increases exposure at precisely the wrong moments. First-level thinking accelerates commitment. Second-level thinking moderates it. The sixth reason is simplicity. First-level thinking is simpler. It does not require modeling other minds. It does not require estimating embedded assumptions. It does not require separating belief from price. Second-level thinking demands multi-layer cognition. It asks, what do I believe? What does the consensus believe? How confident is the consensus? How leveraged is the consensus? What happens if the consensus is slightly wrong? This cognitive load is heavier. It requires intellectual humility and probabilistic thinking. Most market participants do not lack intelligence. They lack incentive to think this way consistently. The seventh reason is momentum reinforcement. When first-level thinking dominates, prices often move in its direction, temporarily. This reinforces belief. Investors who buy into strong narratives see gains. Gains validate reasoning. Over time, the feedback loop strengthens conviction. By the time mispricing becomes extreme, conviction is entrenched. Second-level thinkers must withstand this reinforcement cycle. They must tolerate underperformance during speculative surges. They must resist joining crowded trades even when profits appear easy. This is psychologically demanding. The eighth reason first-level thinking dominates is fear of missing out. When an asset rises sharply, abstention feels like loss. First-level thinking provides justification to participate. Second-level thinking asks whether participation at elevated expectations still provides margin. Often it does not. But abstaining is emotionally uncomfortable. Markets are emotional arenas. Comfort influences participation. First-level thinking aligns with comfort during trends. Second-level thinking aligns with discomfort at extremes. The ninth reason is measurement error. Investors often evaluate decisions by outcomes rather than process. If a first-level decision produces gains, it is interpreted as skill. If it produces losses, it is interpreted as bad luck. This outcome bias masks structural weakness. Second-level thinking may underperform temporarily but protect capital structurally. However, short-term evaluation obscures long-term robustness. Finally, first-level thinking dominates because it is sufficient most of the time. Markets are not always mispriced dramatically. Many assets trade near reasonable valuation. Acting on solid fundamentals may produce acceptable returns. Second-level thinking is most valuable at extremes. Extremes are episodic. Therefore, most participants never feel the need to develop layered cognition. Average performance during stable periods feels adequate. But average performance is not the objective of second-level thinking. The objective is asymmetry. The difference between average and superior long-term performance often emerges during a small number of extreme periods, bubbles and crashes. First-level thinking amplifies exposure during bubbles and accelerates exit during crashes. Second-level thinking does the opposite. It reduces exposure during euphoria and increases exposure during panic, not because of contrarian pride, but because valuation relative to expectation shifts dramatically. This inversion is the core discipline. First-level thinking dominates because it is easy, socially reinforced, narrative-friendly, time-compressed, and emotionally aligned. Second-level thinking requires independence, patience, discomfort tolerance, and probabilistic humility. Most investors are intelligent, few are layered, and in markets, layering is advantage. Section 2 complete, approximately 1,480 words. Next. Section 3, expectations, pricing and the mathematics of surprise, approximately 1,200 to 1,400 words. Shall we proceed? Yes. Section 3, expectations, pricing and the mathematics of surprise, approximately 1,200 to 1,400 words. Excellent. We now move into the structural core of second-level thinking. This section will go deeper into pricing mechanics, probability distributions, expectation gaps, and how surprise, not events, moves markets. Target, approximately 1,300 to 1,400 words. Tone, analytical, layered, institutional grade. Section 3, expectations, pricing, and the mathematics of surprise. Approximately 1,350 words. Markets do not move on events, they move on deviations from expectation. This principle is simple, its implications are profound. When a company reports earnings, the absolute number matters less than the comparison between the number and what the market expected. When a central bank raises rates, the action itself is secondary to whether the move was anticipated. When economic growth slows, the slowdown matters only relative to consensus forecasts. Price is a function of expectation. To understand second-level thinking, one must understand the mathematics of surprise. Let us begin with a simplified framework. At any moment, the price of an asset reflects 1. Expected future cash flows, 2. The growth rate of those cash flows, 3. The discount rate applied to them, 4. The risk premium demanded by investors, 5. Sentiment intensity. Each of these variables is not objective. They are assumptions, and assumptions are aggregated across participants. The market's current price therefore represents the weighted average of collective assumptions. Second-level thinking begins by asking, what assumptions must be true to justify this price? If a stock trades at 40 times earnings, what growth rate is implied? What durability of margins? What competitive moat? What discount rate? Reverse engineering valuation reveals embedded optimism or pessimism. This is the first mathematical insight. The price is not neutral. It is a probabilistic statement about the future. Now consider the role of surprise. Suppose the market expects earnings growth of 20%. The company delivers 20%. The price may not move significantly because expectations were met. If growth comes in at 18%, even though strong, the stock may decline sharply because the deviation is negative. If growth reaches 22%, the stock may rise dramatically because the deviation is positive. The magnitude of price movement is proportional not to the event, but to the deviation from expectation multiplied by the conviction embedded in the prior price. The more confident the consensus, the more fragile the pricing. This is the second insight. Extreme confidence creates asymmetric downside. When expectations are tightly clustered around optimistic outcomes, there is little margin for disappointment. In statistical terms, the distribution is compressed. Compressed distributions are unstable. Second-level thinkers therefore focus on dispersion. They ask, how narrow is the range of outcomes currently priced in? If investors assume smooth growth with low volatility, small deviations can cause outsized repricing. If investors assume disaster, stabilization alone can produce large gains. The mathematics of surprise is not about forecasting events accurately. It is about estimating the probability that the consensus forecast is too tight. Let us examine this through probability. Imagine 3 scenarios for a company. Bear case, 10% probability. Base case, 70% probability. Bull case, 20% probability. If the market prices the company as if the bull case has a 60% probability, the expected return is skewed negatively, even if the company performs adequately. Second-level thinking compares your probability distribution to the market's implied distribution. Edge exists when your distribution differs meaningfully and correctly from consensus, but precision is not required. Small probability miscalculations compound. If the market assigns a 5% chance to severe downturn, and you believe it is 20%, risk management changes. If the market assigns a 70% chance to uninterrupted growth, and you believe it is 50%, valuation attractiveness shifts. Second-level thinking operates in this probability gap. Now consider discount rates. When interest rates fall and liquidity expands, investors demand lower risk premiums. Discount rates compress, valuations rise. If investors assume that low rates will persist indefinitely, they embed that assumption in price. But if rates normalize, even modestly, the impact on discounted cash flows can be dramatic. The surprise is not the rate change itself. It is the deviation from assumed permanence. The same applies to credit cycles. During expansion, default rates appear low, investors extrapolate stability, credit spreads narrow, risk is underpriced. During contraction, defaults spike, investors extrapolate disaster, spreads widen excessively. In both cases, the error lies in linear extrapolation. Second-level thinkers resist extrapolation. They understand that cycles revert, and reversion creates surprise. Now consider the interaction between leverage and expectation. When consensus is optimistic and leverage increases, the system becomes sensitive to negative surprise. A small deviation can trigger forced selling, margin calls, and liquidity stress. The price movement then exceeds the fundamental deviation. This is reflexivity. Price moves influence fundamentals by tightening or loosening financial conditions. Second-level thinking accounts for reflexivity. It recognizes that high expectations combined with high leverage create nonlinear downside. Conversely, low expectations combined with deleveraging create asymmetric upside if stabilization occurs. The mathematics of surprise, therefore, includes second-order effects. Not only what happens, but what happens to positioning when it happens? Positioning magnifies surprise. If investors are fully allocated to an optimistic narrative, positive news has little incremental impact. There are few buyers left. If investors are underallocated due to fear, even moderate positive news can drive strong rallies. Second-level thinkers analyze positioning as carefully as fundamentals. This includes our fund flows, margin levels, short interest, liquidity conditions, institutional ownership concentration. Because price is the equilibrium between expectation and positioning. Now consider long-term compounding. Small positive surprises repeated over time create extraordinary returns. Small negative surprises repeated over time create underperformance even when businesses are strong. This is why high-quality companies can underperform for extended periods. Not because they deteriorate, because expectations were too high. Second-level thinking separates business excellence from investment excellence. Investment excellence requires buying when the expected value distribution is misaligned in your favor. This requires probabilistic humility. You are not trying to predict with certainty. You are trying to estimate where the consensus is miscalibrated, and that miscalibration is often subtle. The mathematics of surprise rewards incremental edge. A 5% improvement in expected probability compounded over decades is decisive, but it requires resisting narrative intoxication. Narratives create expectation clustering. Clustering increases fragility. Fragility increases surprise amplitude. This is why bubbles burst violently, not because growth disappears, but because expectations collapse. The price does not fall from intrinsic value, it falls from inflated expectation. Second-level thinking therefore operates on two axes. 1. Intrinsic value estimation. 2. Expectation misalignment estimation. Both are imperfect, but when aligned with margin of safety, they create asymmetry. The final insight of this section is structural. The market does not reward correctness in isolation. It rewards being more correct than consensus relative to price. If your forecast matches consensus, return is average. If your forecast differs but is wrong, return is poor. If your forecast differs and is sufficiently correct, return is superior. Second-level thinking is therefore not about brilliance. It is about calibrated divergence. And divergence without margin is speculation, which brings us to the emotional engine that drives expectation extremes. Cycles. Section 3 complete, approximately 1,360 words. Next. Section 4, cycles, psychology, credit and extremes, approximately 1,200 to 1,500 words. Proceed. Section 4, cycles, psychology, credit and extremes, 1,500 words. Excellent. We now enter the structural heart of Howard Marks' philosophy. Cycles. Target, approximately 1,500 words. Depth, psychological plus credit mechanics plus historical structure. Tone, institutional, precise, layered. Section 4, cycles, psychology, credit and extremes. Approximately 1,520 words. Markets do not move in straight lines. They oscillate between optimism and pessimism, between risk tolerance and risk aversion, between discipline and excess. Howard Marks emphasizes a fundamental truth. While we cannot predict cycles precisely, we can recognize where we are within them. Second-level thinking does not require calling exact turning points. It requires understanding that extremes create mispricing. Cycles are not purely economic, they are psychological. At the center of every cycle is human behavior. When conditions improve for a sustained period, confidence increases. When confidence increases, risk tolerance rises. When risk tolerance rises, leverage expands. When leverage expands, asset prices inflate. Rising prices validate optimism. The cycle feeds itself. This feedback loop creates euphoria. In euphoric phases, risk premiums shrink, credit is widely available, underwriting standards weaken, narrative optimism intensifies, skepticism is dismissed as outdated. At this stage, first-level thinking dominates. The narrative appears self-evident. Growth seems durable. Volatility appears temporary. Second-level thinkers recognize something different. They do not ask whether the narrative is entirely wrong. They ask whether expectations have become too one-sided. Excess optimism compresses margins of safety. Valuations rise. Spreads narrow. Investors assume favorable outcomes as baseline rather than possibility. This is the dangerous zone. Not because fundamentals are necessarily deteriorating, but because fragility is increasing. Fragility does not announce itself. It builds quietly through leverage and complacency. Credit markets provide the clearest illustration of cyclical psychology. When economic conditions are stable, lenders compete aggressively. Borrowers gain favorable terms. Covenants weaken. Risk spreads narrow. The system appears efficient, but credit expansion lowers the perceived cost of risk. Projects that would not have been financed under stricter conditions are funded. Marginal borrowers gain access to capital. The seeds of future stress are planted during strength. Second-level thinkers monitor credit conditions carefully. They ask, are lenders cautious or aggressive? Are spreads compensating for default risk? Are covenants deteriorating? Is leverage rising systemically? Credit is a leading indicator of cycle maturity. When credit is abundant and cheap, optimism is dominant. When credit contracts abruptly, fear replaces optimism. The shift is rarely gradual, it is reflexive. As soon as defaults rise, lenders pull back. As lenders pull back, liquidity shrinks. As liquidity shrinks, asset prices fall. Falling prices increase perceived risk. Risk aversion spreads. The cycle reverses. Now pessimism dominates. During pessimistic extremes, risk premiums widen dramatically. Liquidity evaporates. Forced selling occurs. Narratives turn apocalyptic. Capital preservation becomes priority. At this stage, first-level thinking becomes defensive. Investors extrapolate deterioration. Negative outcomes are assumed to persist. Assets are sold indiscriminately. Second-level thinkers again ask a different question. Is pessimism excessive? If spreads imply catastrophic default rates, are those probabilities realistic? If equity prices imply prolonged collapse, is recovery even partially plausible? The goal is not to deny risk. It is to assess whether risk is overestimated. This is the inversion that defines cycle-aware investing. Optimism underestimates risk. Pessimism overestimates it. Second-level thinking operates between these extremes. Importantly, cycles are not confined to macroeconomic expansions and recessions. They occur in sectors, asset classes, geographies, and themes. Technology booms, commodity busts, housing surges, sovereign debt panics. Each cycle follows similar psychological phases. 1. Early skepticism. 2. Growing acceptance. 3. Broad enthusiasm. 4. Speculative excess. 5. Disappointment. 6. Capitulation. 7. Recovery. Most participants enter during phases 3 and 4. Second-level thinkers prefer phases 6 and 7, but timing remains imprecise. Marx repeatedly stresses humility about timing. You cannot predict when excess will reverse. You can recognize when excess exists. Recognizing excess allows position sizing adjustments. It allows reduction of exposure when risk premiums are compressed. It allows selective accumulation when spreads are wide and fear dominates. This is not market timing in the conventional sense. It is cycle positioning. Now consider the role of leverage in amplifying cycles. Leverage is neutral in stable conditions. It is destructive in downturns. When leverage is low, price declines are contained. When leverage is high, price declines trigger forced selling. Forced selling accelerates declines beyond fundamental deterioration. This is why second-level thinkers are especially cautious when leverage is expanding. They understand that leverage converts modest surprise into severe price dislocation. The presence of leverage increases the amplitude of cycles. It increases fragility during optimism and volatility during pessimism. Another structural component of cycles is memory. Human memory is short in financial markets. After extended stability, past crises feel distant. Participants assume structural change has reduced risk permanently. Phrases such as "this time is different" emerge. Second-level thinkers distrust such phrases. They recognize that human behavior, not technology or policy, drives cycles. Fear and greed do not disappear, they oscillate. This oscillation creates recurring opportunity, but it also creates recurring destruction. The disciplined investor does not attempt to eliminate cycles. They attempt to survive them. Survival requires recognizing when the pendulum is near an extreme. At extremes, incremental changes in data produce outsized changes in price because expectations are saturated. In optimistic extremes, good news produces limited upside once it was expected. Bad news produces sharp downside. It was unexpected. In pessimistic extremes, bad news produces limited downside. It was expected. Good news produces sharp upside. It was unexpected. This is the asymmetry. Second-level thinkers search for asymmetric setups created by cyclical psychology. They ask, where is the crowd most confident? Where is the crowd most fearful? What is priced for perfection? What is priced for collapse? They do not assume perfection is impossible or collapse unlikely. They assume expectations may overshoot. The discipline is subtle. It does not require bold predictions. It requires incremental rebalancing of exposure. Reducing risk when compensation is low. Increasing risk when compensation is high. This is counterintuitive. It requires selling strength and buying weakness. It requires ignoring momentum signals when valuation diverges from probability. It requires accepting short-term underperformance for long-term robustness. And it requires psychological resilience because acting against cycles feels uncomfortable. At optimistic peaks, caution feels foolish. At pessimistic troughs, buying feels reckless. Second-level thinking is not about being contrarian reflexively. It is about being valuation sensitive across cycles. When prices are high relative to intrinsic value and expectations are elevated, future returns compress. When prices are low relative to intrinsic value and expectations are depressed, future returns expand. Cycles magnify this effect. The final insight about cycles is this: they are self-correcting. Excess sows its own reversal. Optimism encourages risk-taking that eventually produces instability. Pessimism encourages caution that eventually produces recovery. Second-level thinkers do not fight this dynamic, they align with it. They reduce exposure when enthusiasm eliminates compensation. They increase exposure when fear exaggerates risk. Not perfectly, but probabilistically. Cycles guarantee that consensus will be wrong at extremes. Second-level thinking seeks those extremes and prepares for them. Section 4 complete, approximately 1,530 words. Next. Section 5, risk redefined, volatility versus permanent loss, approximately 1,300 to 1,500 words. Proceed. Section 5, risk redefined, volatility versus permanent loss, 1,500 words. Excellent. We now move into one of Howard Marks' most important intellectual contributions, redefining risk. Target, approximately 1,500 words. Tone, rigorous, structural, institutional. Section 5, risk redefined, volatility versus permanent loss. Approximately 1,520 words. Most investors misunderstand risk. They equate it with volatility. If an asset moves sharply, it is considered risky. If it moves smoothly, it is considered safe. This definition is convenient, it is measurable, it is embedded in models. Standard deviation, beta, tracking error. These are statistical proxies for volatility. But volatility is not risk. Volatility is movement. Risk is the probability of permanent capital loss. The distinction is subtle but decisive. An asset can fluctuate widely yet recover fully. Another can appear stable while gradually deteriorating beyond recovery. Second-level thinking begins by separating emotional discomfort from structural danger. Volatility produces emotional discomfort. Permanent loss produces structural damage. These are not equivalent. Consider a distressed bond trading at 40 cents on the dollar during a panic. The price may fluctuate violently as headlines change. Statistically, it appears risky. But if recovery value is estimated at 70 cents with reasonable probability, the volatility represents opportunity rather than danger. Now consider a stable asset trading at extreme valuation multiples. Its price may move gradually upward for months or years. Volatility appears low, yet expectations embedded in price may require flawless execution indefinitely. The true risk lies not in daily movement, but in valuation fragility. If earnings disappoint, repricing can be severe and permanent. This is why Howard Marks emphasizes that risk is not visible in price movement alone. Risk often increases during calm periods. When volatility declines and complacency rises, investors reduce margins of safety. Leverage increases. Risk premiums compress. Low volatility becomes a precursor to instability. Second-level thinkers monitor this inversion. They ask, is the absence of volatility masking underlying fragility? Risk has two components. 1. Fundamental risk, deterioration of intrinsic value. 2. Behavioral risk, mispricing driven by psychology. The most dangerous situations combine both. But often, behavioral risk dominates. Assets become expensive not because fundamentals improve dramatically, but because investors demanded less compensation for uncertainty. Risk premiums shrink. This compression creates asymmetry. If everything goes right, returns are limited because optimism was already priced. If something goes wrong, repricing is sharp. Second-level thinking reframes risk as context-dependent. Risk is not static. It rises and falls with valuation and sentiment. When investors demand high compensation for uncertainty, risk is often lower. When investors demand little compensation, risk is higher. This appears paradoxical, but it follows logically. If you buy an asset at a significant discount to conservative intrinsic value estimates, your downside is partially protected. If you buy at a premium based on optimistic assumptions, your downside is magnified. Volatility does not capture this. Volatility measures dispersion of returns, not probability of ruin. Permanent loss occurs when intrinsic value deteriorates irreversibly or when overpayment eliminates recovery potential. This is why margin of safety is central. Margin of safety is not about maximizing gain. It is about reducing the probability of irreversible loss. Second-level thinkers assume they are wrong frequently. Therefore, they require pricing that absorbs error. Without margin, even small misjudgments can become permanent losses. Now consider liquidity. Liquidity risk is often ignored during stable periods. When markets are liquid, assets can be sold easily. This creates an illusion of safety. But liquidity is cyclical. During stress, liquidity evaporates. Assets that seem stable become illiquid at the worst possible time. Second-level thinkers evaluate risk under stress liquidity assumptions. They ask, what happens if markets close? What happens if leverage must be unwound? What happens if financing disappears? These questions rarely dominate during optimism, but they determine survival during panic. Another component of risk is correlation. Assets that appear diversified in stable periods can become correlated during stress. Diversification assumptions break down when fear dominates. Second-level thinkers do not rely solely on historical correlations. They consider structural exposure. Are risks linked to the same economic driver, the same liquidity channel, the same leverage source? If so, diversification may be superficial. Risk is concentrated, even if volatility appears diversified. Now consider leverage again. Leverage amplifies returns and risk asymmetrically. In upward environments, leverage magnifies gains. In downward environments, leverage forces liquidation. Forced liquidation is the enemy of compounding. It converts temporary decline into permanent loss. Second-level thinking therefore emphasizes conservative leverage, especially when risk premiums are low. The most dangerous time to use leverage is when it feels safe, because safety perception often coincides with compressed risk premiums. Conversely, the safest time to deploy capital aggressively is often when volatility is high and fear is widespread, provided intrinsic value remains intact. This inversion defines risk-sensitive positioning. Risk is highest when compensation is lowest. Risk is lowest when compensation is highest. This statement sounds abstract. It is practical. If corporate bonds yield minimal spreads over government bonds, despite rising leverage, compensation for default risk is low. Risk is elevated. If distressed debt trades at steep discounts implying extreme default assumptions, compensation is high. Risk may be lower than perceived. Second-level thinkers focus on compensation. They ask, am I being paid adequately for the risk I'm taking? If compensation is insufficient, even a safe asset becomes dangerous. If compensation is generous, even a volatile asset may be attractive. Now consider career risk versus investment risk. Many professional investors prioritize career stability over capital preservation. They avoid deviating too far from benchmarks. They avoid contrarian positions that could underperform temporarily. This alignment reduces short-term volatility relative to peers, but it increases exposure to systemic mispricing. If everyone holds the same expensive assets, collective drawdown is inevitable. Second-level thinking sometimes requires accepting career volatility to reduce capital risk. This distinction is uncomfortable, but structural survival demands independence. Finally, risk must be understood probabilistically. No investment is risk-free. The goal is not elimination of risk, it is intelligent risk selection. Second-level thinkers do not attempt to forecast outcomes with certainty. They attempt to construct portfolios where downside is limited by margin of safety. Upside is asymmetric relative to expectations. Leverage is manageable. Liquidity risk is acknowledged. Correlation risk is examined. Compensation exceeds uncertainty. This framework transforms risk from emotional label to structural variable. Volatility may persist, but permanent loss probability declines. The disciplined investor accepts volatility as cost of participation. They reject permanent impairment. This is the essence of risk redefinition. Volatility tests temperament, permanent loss tests structure. Second-level thinking prioritizes structure because temperament fluctuates, structure endures. Section 5, complete approximately 1,520 words. Next. Section 6, margin of safety, patience and distress strategy, approximately 1,500 words. Proceed. Section 6, a margin of safety, patience and distress strategy, 1,500 words. Excellent. We now enter the practical core of Howard Marks' philosophy, how second-level thinking becomes executable discipline. Target, approximately 1,500 words. Tone, strategic, operational, deeply structured. Section 6, margin of safety, patience and distress strategy. Approximately 1,550 words. If second-level thinking is the framework, margin of safety is the mechanism. Without margin of safety, second-level thinking becomes speculation. With margin of safety, uncertainty becomes tolerable. Howard Marks does not claim superior forecasting ability. In fact, he repeatedly emphasizes the opposite. The future is uncertain, forecasts are fragile, economic variables are complex and interconnected. Therefore, the rational response is not prediction, it is protection. Margin of safety is the buffer between price paid and intrinsic value estimated. It absorbs error. If intrinsic value is estimated conservatively at 100 and you purchase at 70, your analysis can be partially wrong without producing permanent loss. If you purchase at 110, your analysis must be nearly flawless. Margin of safety converts uncertainty into manageable probability. Second-level thinkers assume their valuation models are imperfect. They assume unforeseen variables will emerge. They assume cycles will shift unexpectedly. The margin of safety is the structural acknowledgement of that humility. But margin alone is insufficient. It must be combined with patience. Patience is not passivity. It is capital allocation discipline. Most of the time, markets are not offering significant margin. Assets may be fairly valued. Risk premiums may be moderate. Expectations may be balanced. In such environments, second-level thinking dictates restraint. This is difficult. Activity feels productive. Waiting feels unproductive. Professional investors are often pressured to deploy capital continuously. Clients expect engagement. Markets reward participation. Second-level thinkers resist this pressure. They recognize that the majority of long-term returns are generated during periods of dislocation, not during equilibrium. And therefore, patience is strategic. Cash is not a failure, it is optionality. Holding liquidity during euphoric phases is psychologically uncomfortable. It produces underperformance relative to aggressive peers. But liquidity during panic is power. Distress strategy exemplifies this principle. Oaktree Capital Management built its reputation by operating in distressed debt markets, environments defined by fear, forced selling, and liquidity stress. Distressed assets are often misunderstood. When companies approach insolvency, equity collapses. Debt trades at steep discounts. Headlines focus on bankruptcy risk. Sellers are motivated not by valuation analysis, but by mandate constraints, redemptions, or regulatory pressures. In such environments, price diverges sharply from intrinsic value. Margin of safety expands. Second-level thinkers examine recovery value rather than headline risk. They ask, what are the underlying assets worth? What is the realistic recovery rate under restructuring? What probability of default is implied by current pricing? Is that probability overstated? Distressed investing is not about optimism, it is about probabilistic valuation under stress. When a bond trades at 40 cents on the dollar, the market may be implying catastrophic loss. If analysis suggests 70-cent recovery under conservative assumptions, margin exists. The risk is not zero, but compensation is high relative to uncertainty. This is the structural advantage of buying into fear. Fear distorts expectation downward. Margin expands. Conversely, buying into enthusiasm compresses margin. Patience allows second-level thinkers to wait for such distortions. However, margin of safety is not static. It evolves with cycle positioning. In euphoric markets, margin shrinks even for quality assets. Second-level thinkers may reduce exposure even when fundamentals remain strong. This is counterintuitive. It requires separating company quality from investment attractiveness. A wonderful business can be a poor investment at excessive valuation. Marx emphasizes that the price you pay determines your return far more than the quality of the asset alone. This is valuation discipline. Margin of safety is fundamentally valuation discipline applied probabilistically, but valuation alone does not guarantee safety. Structure matters. Second-level thinkers avoid excessive leverage even when margin appears strong. Leverage narrows effective margin. It reduces tolerance for temporary volatility. Distressed investing often involves complex capital structures. Senior secured debt differs from subordinated debt. Recovery values depend on priority. Second-level thinkers analyze structure carefully. Margin is not simply discount to intrinsic value. It is position in capital structure. Owning senior secured claims provides structural protection compared to equity. Understanding structural hierarchy is part of second-level discipline. Another component of distress strategy is psychological resilience. Buying into distress requires acting against prevailing sentiment. During crisis periods, news flow is negative, liquidity is thin, headlines amplify fear. Second-level thinkers rely on analysis rather than atmosphere. They recognize that price collapse often overshoots intrinsic deterioration, but they do not assume automatic recovery. They evaluate business viability realistically. Margin of safety does not eliminate risk. It reduces the probability of permanent loss to acceptable levels. Patience extends beyond entry. It applies to holding. Distressed assets may not reprice immediately. Recovery can take years. Restructuring processes are complex. Second-level thinkers tolerate illiquidity when compensated. They align time horizon with opportunity. This alignment is critical. Short-term capital cannot exploit long-term dislocation effectively. Patience is not merely waiting for entry. It is sustaining conviction through volatility. Another structural element is incremental deployment. Second-level thinkers rarely allocate full capital at once. They scale into dislocation. This reduces timing risk. It acknowledges uncertainty about the precise bottom. Margin of safety allows gradual accumulation without urgency. Finally, margin of safety interacts with cycle awareness. During mid-cycle periods, margin may be modest. During late-cycle euphoria, margin disappears. During crisis, margin expands dramatically. Second-level thinkers adjust exposure accordingly. This does not require predicting macro timing. It requires recognizing when risk premiums are compressed or expanded. Distressed investing is simply the extreme manifestation of this dynamic. In stable markets, mispricing is subtle. In distressed markets, mispricing is obvious, but psychologically intimidating. Second-level thinking bridges that gap. It combines valuation rigor, structural analysis, cycle awareness, and emotional discipline. Margin of safety protects against analytical error. Patience protects against emotional error. Together, they create structural resilience. Compounding does not require constant brilliance. It requires avoiding permanent impairment and deploying capital when asymmetry is favorable. Second-level thinking transforms volatility from threat into opportunity, provided margin exists. Without margin, volatility destroys. With margin, volatility offers entry. This is not a formula for constant action. It is a framework for selective aggression. selective aggression during pessimism, selective restraint during optimism. The discipline is cyclical, the opportunity is psychological, and the execution is structural. Which brings us to the final section, how to build a second-level mind operationally, not as philosophy, but as daily discipline. Section 6, complete, approximately 1,560 words. Next, Section 7, building a second-level mind, operational discipline, approximately 1,500 words. Proceed. Section 7, building a second-level mind, operational discipline, approximately 1,800 words. Excellent. We now close the manuscript with depth and structure. Target, approximately 1,800 words. Objective, transform second-level thinking from concept into disciplined practice. Tone, institutional, reflective, operational. Section 7, building a second-level mind, operational discipline. Approximately 1,850 words. Second-level thinking is not a personality trait, it is not charisma, it is not genius, it is not permanent skepticism, it is a disciplined operating system. Howard Marks does not present second-level thinking as intellectual superiority. He presents it as structured humility combined with psychological independence. The question is not whether you understand the concept. The question is whether you can operationalize it consistently, because markets reward behavior, not comprehension. 1. Separate thinking from acting. The first discipline of second-level thinking is structural separation between analysis and execution. Most investors blend the two. They analyze in real time and act immediately. Second-level thinkers create distance. They ask, what is my thesis? What is consensus? What must be true for consensus to be correct? What must be true for consensus to be wrong? Is price compensating me for being wrong? These questions are written down. Writing matters. Written reasoning creates accountability. It forces clarity. It prevents retrospective narrative distortion. A second-level mind documents assumptions explicitly. Growth rate assumptions, discount rate assumptions, competitive durability assumptions, macro exposure assumptions. This transforms intuition into structure. Without documentation, conviction expands silently. With documentation, conviction becomes testable. 2. Think in distributions, not outcomes. First-level thinking predicts outcomes. Second-level thinking models distributions. Instead of asking, will this company grow? It asks, what is the range of plausible growth outcomes and what probabilities attach to each? Instead of asking, will rates fall? It asks, what range of rate paths is plausible and what is priced? This shift changes everything. It introduces uncertainty formally, it reduces ego attachment, it highlights asymmetry. Second-level thinkers explicitly compare their probability distribution versus the market's implied distribution. The edge lies in probability divergence. Operationally, this means identifying bear, base, and bull scenarios, assigning conservative probabilities, stress testing downside scenarios, evaluating price relative to weighted expectation. This transforms investing from narrative belief into probabilistic positioning. 3. Build anti-consensus reflexes. Second-level thinking requires reflexive skepticism toward consensus comfort. This does not mean automatic contrarianism, it means deliberate friction. When a thesis feels obvious, the second-level thinker asks, why is this obvious? Who disagrees? What would invalidate this narrative? Operationally, this means actively seeking dissenting views, not to confirm bias, but to stress, test conviction. Second-level thinkers allocate time to read opposing research. They study historical analogues. They analyze prior episodes of similar enthusiasm or panic. This prevents narrative intoxication. Comfort is a warning signal. Excess agreement is a red flag. 4. Institutionalize margin discipline. Margin of safety cannot be emotional. It must be procedural. Second-level thinkers define valuation thresholds in advance. They specify maximum acceptable multiple, required discount to conservative intrinsic value, maximum leverage exposure, required risk premium spread. These thresholds are enforced regardless of excitement. This prevents conviction from eroding structure. It also prevents "this time is different" rationalizations. Operational discipline means that if margin is insufficient, do not act, even if the story is compelling, even if peers are profiting, even if media enthusiasm is intense. Second-level thinking requires structural obedience to margin rules. V. Respect cycle positioning. Second-level minds maintain awareness of where they stand within broader cycles. This does not require precise timing. It requires context awareness. Operationally, this involves monitoring credit spreads, leverage levels, IPO activity, valuation dispersion, liquidity indicators, investor sentiment surveys. When spreads are tight and enthusiasm is high, exposure should decline incrementally. When spreads are wide and fear dominates, exposure should increase incrementally. This rebalancing is gradual. It is not heroic. It is probabilistic. The discipline is subtle. Reduce risk when risk feels invisible. Increase risk when risk feels overwhelming. This inversion requires psychological training, which leads to the next discipline. Shestes train emotional neutrality. Second-level thinking is emotionally countercyclical. This demands deliberate temperament conditioning. Volatility must not provoke reflexive reaction. Euphoria must not provoke greed. Operationally, this can include limiting real-time price monitoring, avoiding constant financial media exposure, creating decision windows, for example, weekly reviews rather than daily reactions, enforcing cooling-off periods before significant allocation changes. These mechanisms create distance between stimulus and response. Second-level thinkers do not eliminate emotion, they design around it. 7. Align time horizon with strategy. Many investors fail not because they are wrong, but because they are impatient. Second-level thinking often requires waiting for mispricing to resolve. If capital is short-term and opportunity is long-term, structural tension emerges. Operational discipline requires alignment. Long-duration opportunities require stable capital. Distressed strategies require tolerance for illiquidity. Contrarian positions require patience through underperformance. Time arbitrage is a hidden advantage. Most participants operate on compressed evaluation cycles. Those who extend horizon gain edge. Second-level thinking leverages time asymmetry. 8. Separate identity from outcome. This is perhaps the most subtle discipline. Overconfidence and consensus pressure both stem from identity attachment. If being right defines self-worth, second-level thinking collapses. Operationally, this means evaluating decisions by process adherence rather than short-term outcome. Was margin respected? Was probability analysis rigorous? Was consensus assessed? Was exposure sized appropriately? If yes, a negative outcome is tolerable. If no, a positive outcome is misleading. This process orientation stabilizes behavior. It reduces ego volatility. It reinforces structure. 9. Accept infrequency of true opportunity. Second-level thinkers accept that true mispricing is rare. This reduces the urge to manufacture activity. Cash becomes a position, inaction becomes strategy. The discipline to do nothing when edge is absent is among the most difficult operational behaviors. But it is essential. Excessive activity erodes edge. Patience compounds. X. Build structural redundancy. No analysis is flawless. Second-level thinking incorporates redundancy. Operationally, this includes independent valuation methods, scenario re-evaluation under different macro assumptions, peer review of thesis, devil's advocate assignments. Redundancy protects against blind spots. It slows decision-making, but speed is rarely the source of durable edge. 11th, recognize that you compete against psychology. The market is not an equation, it is a psychological ecosystem. Second-level thinking is competitive only because others fail to manage emotion at extremes. Therefore, building a second-level mind is less about intelligence and more about behavioral architecture. The edge is psychological composure under stress and restraint under enthusiasm. 12th, understand the limits of forecasting. Second-level thinking does not rely on precise macro prediction. Marx emphasizes humility about forecasting. Operational discipline means Avoid concentrated macro bets. Avoid dependence on precise timing. Avoid leverage predicated on narrow scenarios. Instead, build portfolios resilient across plausible distributions. Robustness beats precision. Trece. Final integration. A second-level mind integrates valuation awareness, expectation analysis, cycle recognition, margin enforcement, emotional neutrality, time alignment, structural redundancy, identity detachment. This is not an intellectual trick, it is a behavioral system. Second-level thinking transforms investing from reactive participation into probabilistic positioning. It does not guarantee outperformance. It increases probability of asymmetry over time, and that is enough. Closing reflection. Howard Marks' philosophy is not about predicting the future, it is about positioning intelligently relative to expectation. First-level thinkers compete with reality. Second-level thinkers compete with consensus perception. The difference is subtle, the consequence is profound. If there is one operational principle to carry forward, it is this: your edge is not in knowing more. Your edge is in thinking differently about what is already known and acting only when price compensates you for that difference. That is second-level thinking. Not brilliance, structure, not prediction, positioning, not ego, margin,